What's up guys, it's Kyle with Next Door Trader, and today we're going to talk about 3 keys to risk management in your trading. Super important topic, so let's dive right in. Key number 1 is you want to make sure you understand your sizing on every single trade. Well, what does it mean to understand your sizing? Well, you want to make sure you know how much money you have at risk on every single trade. If you don't know that, you're always kind of guessing, thinking about, okay, like how many contracts should I do on this trade? Should I take a different number of contracts on this one? That should always be predefined for you. So you should know exactly where your stop loss is going to be and what dollar amount that equates to, so that you can select the right number of contracts or position size on your trade. You should know exactly where your profit target's going to be, so you know you have good enough reward to even take that trade. But knowing how to size appropriately is going to help you manage your risk well. So what are some actual rules you can think about in terms of sizing? I like to think about taking trades that are somewhere between 0.5% or 1% of my portfolio. So as an example, if you're trading on something like $1 million account, that means my average risk that I have in each trade is somewhere between $5,000 and $10,000. So if that trade comes back and hits my stop loss, then I lose between 5 and 10 grand on that particular move. But it's based on a percentage, and I always know what that size is going to be. That way I can put myself in a position to do stuff like, hey, I'm gonna risk 5,000 to make 10,000, or I'm gonna risk 5,000 to make 15,000. Knowing your sizing puts you in a really good reward to risk position. Now, if your account's a little bit smaller, you may not have to take that small size of trade. Let's say you have a $1,000 account, for example. Well, if you're only risking 1% on a $1,000 account, you're probably going to be willing to risk more than 10 bucks on that particular trade. So you may be willing to risk, closer to 50 bucks, which means you can take a 5% risk size on that particular trade. So I'm willing to risk 5% to make 10%. That's why it's actually easier to get better returns on a smaller account, because the dollar amount you have at risk is a lot less. But either way, you should always know what that percentage is and align it with what you're comfortable risking. Same example, you have a $1,000 account. If you're not willing to lose $100 on a single trade, then you can't take a 10% risk size. You need to take a smaller size than that. And there's no right or wrong answer to this. You really need to work at your own pace. But the important thing is you need to understand what your sizing is on every single trade that you take, so that you can always put yourself in a good reward to risk position. You're always able to earn more than you could lose, and you're never risking more than you're comfortable with. Step number 2 in having a great risk management plan is to actually smash that like button. So I know that you like more content like this on trading, helping make you a better trader. I can provide you a lot more videos and education on that. But really, step 2, what you want to think about is actually sizing down after a losing trade. But what do I mean by sizing down? So let's go back to my $1 million account example. And let's say my normal risk size is 0.5% per trade. So I'm risking $5,000 per trade, and I lose my first trade on that day, or my first trade on that week. What I would think about doing on the next trade is cutting my position size in half. So rather than risking $5,000 again on the next trade, I'm gonna risk $2,500 on that next trade and pursue something like a 2-to-1 or 3-to-1 type reward trade. So now I'm gonna risk $2,500 to get back to 5. I'm gonna risk $2,500 to get to 75 and still be profitable on the day. By doing things that way, it may seem like it's taking longer to grow, because every time you lose, you're sizing down a little bit, and it's frustrating because you want to take the same size and make it back as quick as possible, but it will keep you in the game for a long time. And that's really what trading comes down to: survive in advance so you can make profit. Ultimately, stock market is just, taking money from some people and putting it in your pocket, and it sounds terrible, but that's what it is. And if you can play that game long enough, you're going to be the one grabbing the dollars. So by sizing down after a losing trade, it makes it really hard for you to draw down your account, because you're constantly decreasing your size but pursuing for higher reward trades so that you can make that drawdown back. So each time you lose, you're taking a smaller size trade and then pursuing higher reward to either get back where you were or get slightly above where you were. And you can repeat that process over and over again. What that does is it keeps you in it for a long time. So you'd have to lose several trades in a row to really significantly draw down your account. And if you have a great strategy, that should not happen. Maybe you lose a few in a row, but if you have a great strategy, really you shouldn't lose any more than that, okay? The other advantage of sizing down is it helps you with the mentality of losing. So hey, we have less risk on this trade, so you're gonna feel a little bit more comfortable getting back in into the market and taking another trade, knowing that, hey, I'm risking less on this one. My potential reward is higher, can get me back to where I was before. So taking that kind of mentality is extremely important because it lets you build things up over time without ever risking severe drawdowns on your account. So if you've ever heard stories about people blowing up their accounts, it's because they don't do this. They do the opposite, right? They lose a trade and they go even bigger on the next one because they know they can make it back faster. And it's just a terrible way to do it. It's a good way to blow up your account, and you're never gonna be long-term successful that way. But if you take this approach, it keeps you in the game for a long time and helps you build things up. And you can think about it almost like a competition, like you're playing a game at the start of every single week. So I'm gonna start my week, my first trade. If it's a winner, great. On my second trade, I may take a little bit off so I don't risk giving up my profit if I'm taking another trade that day. If I lose that trade, I'm definitely taking some off and then pursuing for higher reward in order to get that position size back. And that's how you stack together an entire week of profitable trading, by controlling your sizing like that on every single move. So step number 2 is actually be able to adjust your position sizing based on losing or winning a trade. Step number 3, and this is maybe the most important for new traders, really comes down to acceptance. If you want to have a great risk management plan, you need to accept the fact that you are going to lose trades. It is 100% part of the process and unavoidable. And that's really hard for a lot of people. One, they don't like to lose to begin with. It's kind of ingrained in our culture to not like losing. You feel like you want to win all the time. But 2, it's hard to see money on your account go backwards. The temptation is going to be to immediately try to make it back, make some poor decisions, size up on trades. You need to accept the fact that you're going to lose. In fact, you could lose half the time or more and still be an extremely profitable trader. So don't think of losing trades as a failure. Think of it as just part of your risk management plan for that particular week. You prevented yourself from losing more money by following your risk management plan and taking a loss when that trade didn't make sense anymore. And if you put these things together, that's how you can stay in the game of trading for a long time. You think about and always know your position sizing. You adjust your position sizing based on whether you won or you lost, and you accept the fact that, hey, you know what? It's okay to lose. In fact, losing is a necessary part of being a profitable trader. And the sooner you come to terms with that, the more success you can have and the quicker you can move through your progression of making profit and maybe leaving your job one day to do this full time. But that's how you create a good risk management plan. Those are the 3 keys. Hope you guys liked this video. If you did like it, be sure to share it, like, subscribe, and we'll see you guys on the next one.